Welcome back to Learn SKN, and today we're going to pick right up where we left off from the last POB video. The last one we looked at section 5 in section specific objective 5 in section 8 business finance. We looked at outline ways used by individuals to manage personal income, and so we were going to cover 6 but we didn't, so we're going to cover 6 right now. We're going to look at the difference between savings and investment. All right, so we're not going to waste too much time. We're going to just jump right into it. So this is basically the sequel to the previous principles of business video. Now, savings and investment. What's the difference between savings and investment? As I said earlier, you cannot really grow wealth by saving, right? Because some saving schemes don't have enough of a return for you to be able to, make bank on it. Investment, on the other hand, once you invest smartly, you'll be able to have good returns on said investments. Savings and investment are key to achieving financial security. Individuals and families who are fortunate enough to have a surplus of income over expenditure can decide to increase the expenditure, for example, by buying a new car or going on holiday. However, by doing so, they would enjoy themselves in short term, but they would not be safeguarding their future. That's what I'm saying. So savings cannot really build wealth. Something happens, car breakdown, somebody gets sick, that savings gone. But if you invest and you have money constantly coming in based on your investment, then you're basically securing your future, securing the bag just like that. All right. As we would have seen with budgeting, unexpected costs should be expected. It would be wise, therefore, for families or individuals that can afford it to put money aside for a rainy day. This is because illness can occur, unemployment can happen, and cars can break down. I mean, 2020 is such a weird year, right? So many things happen. A lot of people lost their jobs. A lot of people are out of work still, especially the tourism industry. So, those persons would have liked to have had, at least X amount of months of savings put down to help them through this whole hardship right now. All right, but so people often save by putting aside money in a bank or building a society savings account. Savings allow people to better deal with unexpected financial situations that can sometimes occur in life. In addition, regular savings allow people to accumulate money over a long period of time in order to afford or to achieve set financial objectives. For example, funding their children to university, putting down a deposit for a house, or buying a plot of land. There are a number of ways people and organizations can save money. So with that said, like I said before, savings, as long as nothing happens, it could pay off for you in the long run, but let's hope, as I said, there are no unforeseen events, because that would just eat through your savings. Of course, there are different ways of saving, and of course one of the obvious ones would be interest-bearing deposit bank accounts. So you're basically saving accounts. All right, you're saving accounts. And to be honest, like I said, this is there, but the returns are low, about maybe 2%, if that much. So that wouldn't really build wealth, but at least you have somewhere to put your liquid cash so that if something happens, you just go and withdraw and start out your business with whatever might have happened. Then you have short-term fixed deposit. This one is a little better than regular savings in that you are going to put a sum of money away. You can't really touch it until the time has passed, till it has matured, and then the bank would add significant interest, sometimes compound interest on that total. So you might end up getting, a 5-10% more than invested when it matures. So, you get something back, you get a good return, but still, as I said, short term, it's not for the future. It's not for building wealth, as I said before. Maybe if you do this in short term and then take the proceeds from that, put it somewhere, invest it somewhere, and then take the principal and fix it again, then you have a system that you can work on to get some wealth growing. This is a deposit made at a bank or other financial institution where the money cannot be touched for a fixed period of time. This could be anything from a few months to several years. In return, the bank agrees to pay interest to the customers in compensation. All right. The disadvantage for savers is that their money can only be withdrawn when agreed terms of deposit has been reached. Like I said, I said before, you need liquid cash. A fixed deposit is not liquid cash. You have to go through all kind of red tape to break it if you want it to before the maturity date. Sure, if all goes well, it pays off good in the end, but if you have an emergency, then you will have to go and break it, and you have to go through all kind of red tape, and so it's not really liquid. You still need your liquid cash to be able to be flexible. Then of course you have what you call susu in some countries in the Caribbean. Some others call it partner hand. You know, that's where you have the savings scheme where, you know, a bunch of friends come together and everybody contribute to a pool. Then they give that money to somebody this month, some money to that money to somebody else the next month, and so on until everybody gets their hand, and then it start over again. I mean, in recent months, you realize that there has been this, you know, this kind of scheme going around since COVID, and it's not really legit per se, where they're asking people to contribute X amount of US dollars to a group, and then, you know, somebody gonna pay somebody something, and by the time you get the returns, it is too good to be true, right? And so you have seen that police have had to arrest people for not giving people their money. It's a real big scheme, so be careful. So with Susu, same thing with that scheme, you have to make sure that those you're entering with are people you trust. You can't just enter with anybody, because when they get the money and they're gone and they can't find them, you know, it's trouble. So you have to be somebody you can trust, a friend, a close friend, family, so that you know that you're going to get your money when your time comes. So Susu is a kind of informal way of saving, but of course the downside to that is it's not regulated. So, you know, things go south, you know, it's hard. And also, there's no interest rate. There's no interest. So you just basically, you get the back principal. So that's the next downside to it. There's no interest, but it can come in handy when your turn comes. You get a big lump of money one time, so that you can invest elsewhere, because you might have that same money you would have spent, you know, elsewhere along the line, but now you have it one shot, one lump sum, and so you can do things with that kind of money. But of course, like I said, you have to trust the people when you're going in. So as you can see, so one of the key differences between interest, investment, and savings is the fact that investment is about basically the future, getting future returns. You can build wealth on investments. You cannot really build wealth on savings. Savings can be eaten out one time. I mean, I'm not saying all investments are secured, because, you know, a company goes under, that's it, your money gone. You know, stock market go plunge, your money gone. But, you know, you still have a chance of, you know, high risk, high reward kind of thing. All right, so that's totally up to you. So investment means to put money into investments with the hope that this money will grow over the long term. So that's the point. You know, put it in now for later, for future return. That's the whole definition of investment, you know, now for later. Such investments include stocks, bonds, mutual funds, and of course, real estate, property. That's one of the biggest, you know, ways of investing, one of the best ways of investing. Once you can get it done, the returns are tremendous as it relates to the real estate market, right? If you are trying to accumulate a relatively small amount of money for a short-term goal, such as buying a TV, or then savings would be appropriate. So, as I've been saying, savings, short-term, investment for the future. All right, good. So, you know, these are things that you can invest in. You know, company. You can buy shares in a company, and so if the company pays dividends, you get some returns on the shares that you own. So based on what the company decides to pay, you can, you know, make a killing on certain returns, you know, whenever they pay dividends. So buying shares in a company is a good way, especially when you come on early and the company, you know, skyrockets and you end up being wealthier for it. A lot of persons who own stock from Google and Amazon and Apple early o'clock, you know, they are millionaires today, some billionaires today, because they invested early and the company took off, and, you know, now they are reaping the rewards. Now a stock from Apple cars, one stock costs like $1,000 US and that kind of stuff. So it's hard to get in right now. So you have to go and seek, you know, startups and see where you can get in on the ground floor and, you know, get the money from the future earnings. Now the thing about shares is that they are traded on what we call stock exchange. Now in the Caribbean, for the most part, our exchanges are not as mature as, you know, the New York Stock Exchange or whatever. Now the main aim is just to buy the stocks when they're low and sell when they're high. That's the aim. You know, cash out when they're high. But, you know, sometimes people hold on to stocks too long. You know, they end up giving to their grandchildren and stuff like that. So, you know, it depends on what you want out of the stock market and the company shares. You might want to hold on to the company shares. I might just want to buy when it's low, sell when it's high, and then take that money and invest it elsewhere. But of course, there's a risk to investing in companies, in that if the company goes down, then all that money you invested basically gone for naught. So if the company goes down, you know, you might have bought these shares for, let's say, $10 a share, and then, you know, some bad news come about the company, and people just start selling the stock, and so the stock price plummets, and so therefore you're gonna lose some money, you're gonna lose on the shares. So like I said, risk reward. There are only so many Amazons and Googles and, you know, Facebooks to go around, and then you have other companies like Quibi and, you know, other Vine and all those companies that just, you know, start high and fizzle out and stuff like that. So investing in companies' shares can be rewarding and also very risky. So the same thing for investment in general. You have your high risk, your low risk, and then so you'll know, you know, what risk you want to take. If you're risk averse, you know what to do. If not, you have to do your homework person. You have to do your homework to know which shares are best. And of course, you can invest in bonds and debentures. All right, bonds are like IOU from the government and companies where, you know, you give them some money and they say basically they owe you, and so after a certain time have passed, they will repay you that money with interest. But the difference is that with a bond, you're not part owner. With a share, when you buy a share, you're part owner of the company. With the bonds, you're not part owner. You just other people owe you some money, they pay you back with interest, and that's it. Business over. Once you mature, business over. All right. So the same way with the debentures and that kind of stuff. You're not gonna be owner. You just lend them some money to get started, and then when they get the profits, they repay you with interest, and that's basically how that goes. But one of the easier ways to invest would be through what I call a mutual fund. Now, a mutual fund is a way of avoiding risk that if you don't understand the stock market, or if you don't have the time to do that, you pay persons to do it, you pay your brokers to do that. What they would do, they would take your money and they would invest across different stocks in different sectors, different industries. You know, they will try to balance your portfolio as much as possible. You know, so when one goes down, the next one goes up. So for example, if oil goes down, electric vehicle goes up, you know, they balance the kind of stuff. So that's what a mutual fund is for, to help you to manage your money, to invest in the stock market, in shares, in companies, without all the headache and hassle and of knowing what to do and being there to buy and sell. You know, when it's low you buy, when it's high you sell. All the rigmarole, you don't have to worry what you heard about that. You pay somebody and a mutual fund will sort that out. But of course, again, problems, risk are involved in everything, and so there have been epic failures of mutual funds in the past. A lot of people retirement money just gone to naught because, you know, somebody squanders some money by the money you invest in the wrong thing. So mutual funds in themselves have their own risk. A mutual fund is a professionally managed investment fund that pools money from many investors to purchase a wide range of different stocks and shares on their behalf in return of management fees. So of course, risk is involved with anything with investment. All right, so that's basically it for this video. That's it. We looked at, you know, personal savings, budgeting, and we looked at, you know, ways you can save, places you can put your money. We look at the difference between saving and investment. We look at ways you can invest your money, you know, bonds and stocks and real estate and that kind of stuff. All right, so that's it for that. Next video we're going to look somewhat finance. So of course, you know, if you want to know when that video drops, you have to like, subscribe, and of course hit the bell to know when Learn SKN would have dropped another video. Thanks for watching. Thanks for listening.